The absolute cornerstone of the investment philosophy of Warren Buffett revolves around a concept that sounds almost too simplistic to be taken seriously by professional wealth managers. Rule number 1 is never lose money. Rule number 2 is never forget. Rule number 1. When amateur investors first hear this declaration, they often roll their eyes in frustration. Obviously, nobody actively plans to lose their hard-earned capital when they enter the financial markets. However, what he actually means requires a very deep understanding of risk management, behavioral psychology, and the brutal, unforgiving mathematics of ruin. The truly wealthy recognize a fundamental, critical difference between temporary market volatility and permanent capital loss. Volatility is simply the daily fluctuation in the price of an asset based on the news cycle. Your portfolio dropping by 5% on a random Tuesday because of a negative macroeconomic report regarding inflation is merely volatility. Permanent capital loss, on the other hand, occurs when you invest heavily in a structurally flawed enterprise that ultimately goes bankrupt. Or worse, when you allow sheer emotional panic to dictate your actions, and you sell a high-quality asset at the absolute bottom of a market crash. The mathematics of losing money are completely asymmetric and heavily stacked against the investor who takes unnecessary risks. If you have £10,000 and you experience a 20% loss, you are instantly down to £8,000. To get back to your original £10,000, you do not just need a 20% gain. You need a 25% gain. The deeper the financial hole you dig for yourself, the exponentially harder it becomes to climb out. If you invest that £10,000 into a highly speculative asset based on internet hype, and the asset drops by 75%, you are left with a mere £2,500. To recover from a 75% loss, you need a staggering 300% return on your remaining capital just to reach the point where you initially started. The wealthy completely avoid these deep, devastating holes by insisting on maintaining a massive margin of safety at all times. They meticulously look for assets that are currently priced so far below their actual intrinsic value that even if their financial calculations are slightly wrong, or if the broader economy suddenly enters a severe, prolonged recession, their principal investment remains protected. They absolutely do not chase a potential 200% return if that return comes attached to a 50% risk of total financial ruin. Instead, they patiently and quietly wait for clear opportunities where the downside is heavily capped and the risk is minimal. This deeply defensive mindset is the silent, powerful engine of long-term wealth retention. While amateur retail investors are constantly scouring the internet, looking for the next big thing that will miraculously double their money in a single month, the quiet rich are diligently analyzing risk and intelligently structuring their portfolios to easily survive worst-case economic scenarios. They understand that if you simply avoid making catastrophic, emotionally driven financial mistakes over the course of a lifetime, the incredible power of average market returns will inevitably make you exceedingly wealthy. In a modern consumer world obsessed with outward appearances, the general public has been heavily conditioned to completely confuse price with intrinsic value. We look at a luxury item displayed in a shop window in Mayfair, carrying a £5,000 price tag, and we automatically, subconsciously assume it holds immense intrinsic worth. We mistakenly equate the high cost of acquisition with the fundamental, underlying value of the object. The global financial markets operate in the exact same psychological manner, which is precisely why so many amateur investors fail so miserably over the long term. Every single weekday, from the morning opening until the final closing bell, the stock market acts as a highly emotional, irrational voting machine. It arbitrarily assigns a price to a business based on the collective greed, fear, and speculative mood of millions of participants. But the quiet rich know that the daily ticker price flashing on a computer screen has absolutely nothing to do with the actual tangible value of the underlying commercial enterprise. They absolutely do not buy a stock simply because the line on a digital chart has been trending upwards for 3 consecutive weeks. They deeply understand that buying a share means buying a fractional ownership stake in a real, breathing commercial enterprise. To determine the true value of that enterprise, you must look far beyond the daily share price. You must develop the rigorous discipline and ability to accurately read and fully comprehend complex financial statements. While retail day traders are frantically obsessing over short-term technical patterns and momentum indicators, professional wealth builders are quietly digging deep into the income statement of a publicly traded company. They carefully analyze the revenue streams to see if they are consistent, reliable, and growing organically year over year. They do not just stop at the top-line revenue figure. They meticulously strip away the cost of goods sold to calculate the true gross profit margin. They desperately want to see if the company has genuine pricing power. They ask themselves if the business can successfully raise its prices during a period of high inflation without completely losing its loyal customer base. They then look incredibly closely at the operating expenses. A truly great business must not be bloated with unnecessary administrative costs or excessive management compensation. By rigorously reading these financial reporting metrics, they can accurately determine the true operational efficiency of the executive management team. They analyze exactly how the business handles complex accounting principles like depreciation and amortization to arrive at a highly realistic, conservative net income figure. The ultimate, overarching goal of this deep corporate financial analysis is to discover a business possessing a massive, impenetrable economic moat. A moat is a structural competitive advantage, whether it takes the form of an incredibly strong consumer brand, a captive network effect, or a massive logistical cost advantage that makes it practically impossible for rival competitors to steal their market share. The wealthy are perfectly happy to deploy their capital into a profoundly boring, unglamorous sector that simply generates massive, predictable, boring cash flow every single quarter, rather than gambling their money on a highly publicized technology startup that burns through massive amounts of venture capital and has never produced a single pound of actual, verifiable profit. True, lasting value is always found in the unexciting reality of strong balance sheets and solid, undeniable income statements, not in fleeting media hype or social media trends. The third rule represents the absolute most powerful force in the entire realm of finance, yet it is simultaneously the one that requires the absolute greatest amount of human patience. It is the concept of uninterrupted compounding. Warren Buffett has frequently compared the entire wealth-building journey to the physical act of rolling a snowball down a very long, snow-covered hill. To build an enormously massive snowball, you do not need to push it with incredible, exhausting physical force. You simply need 2 distinct elements. You need sticky snow, which represents steady, reliable, positive financial returns, and you need a very long hill, which represents multiple decades of uninterrupted time. It is a highly sobering, incredibly revealing statistical fact that Warren Buffett acquired over 99% of his massive, world-renowned fortune after he reached the age of 50. While he is certainly a brilliant financial analyst, his true, undeniable superpower is an almost superhuman level of patience and emotional control. Compounding is simply the mathematical process where the financial returns generated by your initial capital begin to generate their own returns. In the early years of the process, the visible growth is agonizingly slow. It is so utterly slow and unremarkable that the vast majority of normal people get extremely bored or discouraged and abandon the strategy entirely to chase faster, riskier returns. But if the process is left completely uninterrupted, the growth curve eventually turns strictly vertical, generating wealth at an astonishing rate. Let us examine exactly how this works in a practical, everyday setting for someone living and working in the United Kingdom. The government provides an incredibly powerful, entirely legal wealth-building tool called the Stocks and Shares Individual Savings Account, commonly referred to as an ISA. Every single tax year, you are allowed to invest up to £20,000 into this highly protected account, and every single penny of capital growth and dividend income generated inside it is completely and permanently shielded from taxation by the government. If a young professional strictly commits to investing a steady, predetermined amount every single month into a low-cost, broadly diversified global index fund, tracking the largest companies on Earth, they are harnessing the exact same mathematical force that the billionaires utilize. When the massive global companies in that index fund pay out their quarterly dividends, the quiet rich do not withdraw that cash to spend on a luxury holiday or a depreciating new car. They automatically reinvest every single penny of those dividends to buy even more shares, which in turn will generate even more dividends the following year. Over a continuous period of 20 or 30 years, the compounding results become absolutely staggering. The final balance of the investment portfolio will completely dwarf the actual cash contributions made by the investor over their working life. The vast majority of the accumulated wealth will consist entirely of the compounded growth layered upon the original capital. The absolute greatest mistake that the middle class constantly makes is interrupting this silent, powerful process. They experience a brief moment of panic during a temporary economic downturn and completely liquidate their portfolio. They foolishly attempt to time the market by jumping in and out of different investment funds, constantly chasing whatever specific sector happened to perform best the previous year. Every single time you sell your compounding assets, you completely reset the mathematical clock back to zero. The truly wealthy build their robust portfolios, carefully automate their monthly investments, and then purposefully look away to focus on their lives. They go about their daily business and simply let the underlying mathematics do the heavy lifting in the background over the course of several decades. If you regularly consume mainstream financial news broadcasts or read the daily financial newspapers, you are constantly and deliberately subjected to an intense, overwhelming barrage of extreme negativity. The entire modern media ecosystem is fundamentally designed and optimized to capture and hold your attention, and basic human psychology is hardwired through evolution to pay far more attention to potential threats than to positive, steady developments. Pure fear drives maximum engagement. Fear keeps you glued to the television broadcast and ensures you keep clicking on the sensationalist articles. You will constantly see massive, bold headlines screaming about an imminent, catastrophic recession, rapidly skyrocketing interest rates, completely collapsing property markets, and the inevitable impending destruction of the global economic system. This relentless, deafening noise is specifically engineered by media corporations to trigger a primal fight or flight response within your brain. Warren Buffett and the exceptionally quiet rich operate on a completely different, highly controlled emotional frequency. The absolute most famous and heavily quoted advice attributed to him regarding this specific psychological phenomenon is the firm instruction to be fearful when others are greedy, and to be profoundly greedy only when others are deeply fearful. The truly wealthy absolutely do not base their long-term financial strategy on the panicked, sensationalized headlines of the current day. They possess an unwavering, historically grounded understanding that macroeconomic cycles are completely normal and unavoidable. Bear markets, severe economic recessions, and sudden, violent market crashes are not strange, unpredictable anomalies that signal the end of the world. They are absolutely guaranteed, entirely natural features of the global capitalist system. They have happened countless times before, and they will absolutely happen again in the future. When a massive market correction inevitably occurs, the average retail investor hastily logs into their digital brokerage application, sees a terrifying sea of red numbers indicating huge paper losses, and feels a desperate, uncontrollable urge to sell everything immediately, simply to stop the psychological bleeding. They allow pure emotional panic to completely dictate their financial actions, and in doing so, they permanently lock in their financial losses, destroying their future wealth. When the exceptionally wealthy look at the exact same terrifying market crash, they see something entirely different. They see the absolute greatest wealth transfer opportunity of the current decade. They logically view a severe economic downturn as a massive, highly lucrative discount sale on the most robust, deeply profitable companies in the entire world. Because they strictly live below their means during the good times and constantly maintain incredibly strong cash reserves, they have the required capital fully ready to deploy precisely when everyone else is running terrified for the exits. They aggressively utilize that patiently held cash to acquire exceptionally high-value assets at absolute rock-bottom prices. To successfully execute this deeply contrarian strategy, you must develop an immense, almost unnatural amount of emotional discipline. You must actively cultivate the strong psychological fortitude to actively and consciously ignore the screaming, irrational panic of the crowd completely surrounding you. You have to be entirely comfortable looking foolish and out of touch in the short term to absolutely guarantee your massive financial wealth in the long term. The fifth and final rule is perhaps the absolute most critical piece of actionable advice for anyone who is currently starting their long wealth-building journey from a position of absolute zero capital. During times of immense economic distress, dangerously high inflation, and widespread global uncertainty, terrified people constantly and frantically search for the absolute perfect safe haven asset. They endlessly debate whether they should move all their money into physical gold bullion, heavily leverage themselves into residential real estate, or buy highly complex baskets of foreign currencies. When Warren Buffett is repeatedly asked this specific question by anxious investors, his profound answer remains incredibly consistent and remarkably simple. He clearly states that the absolute best, highest returning investment any human being can possibly make is a direct, heavy investment in their own personal abilities and knowledge. The more you actively learn, the more you will inevitably and permanently earn. Severe inflation is a silent, invisible thief that constantly and relentlessly erodes the actual purchasing power of the pound sterling sitting idly in your high street bank account. A brutal, prolonged bear market can temporarily wipe out half the paper value of your carefully constructed retirement portfolio. A localized, severe housing crisis can completely destroy the built-up equity in your residential property. However, absolutely no one in the world can ever take away your accumulated knowledge. No government entity can legally tax the complex skills securely stored inside your head. No central bank can ever inflate away your hard-earned professional competence. No severe economic downturn can steal your professional expertise or your ability to solve complex problems. The truly wealthy deeply understand that their own intellect and capacity to learn is the absolute ultimate compounding machine. If you dedicate your time, intense focus, and energy to becoming exceptionally competent at something the free market heavily values, you will always be completely financially secure. This means actively and deliberately acquiring high-income skills that are incredibly difficult for an employer to replace. For instance, if you spend significant time mastering highly complex data management, learning exactly how to intricately manipulate massive corporate data sets, using advanced, highly technical spreadsheet functions to seamlessly calculate seniority formulas or extract critical business intelligence, you instantly become practically indispensable to any large corporation. If you actively develop a highly trained, sharp eye for complex technical graphic design, deliberately specializing in creating modern, highly detailed flat vector infographics, utilizing clean lines and perfect geometric proportions, you possess a highly monetizable, easily transferable creative skill that modern businesses constantly and desperately need for their digital marketing and corporate communications. Even developing a deep, intensely practical understanding of advanced corporate financial analysis, knowing exactly how to accurately interpret a complex income statement to correctly judge the fundamental health of a sprawling business, elevates your professional market value immensely. Furthermore, dedicating time to deeply engaging with rich reading culture, meticulously analyzing profound literature to dramatically improve your written and verbal communication skills provides a massive, undeniable advantage in any professional environment. You will always be absolutely able to command a massive premium income, regardless of the broader macroeconomic weather, because you offer highly tangible, easily measurable, and incredibly rare value to the global marketplace. The truly wealthy are utterly voracious readers and relentless, deeply committed lifelong learners. While the vast majority of the general population completely stops actively studying the very day they joyfully receive their formal university degree, the quiet rich fully understand that institutional education is merely the absolute baseline warm-up. True, massively profitable education is a daily, relentless, lifelong pursuit of absolute excellence. They constantly upskill, read deeply and broadly across numerous disciplines, and constantly refine their professional craft, knowing with absolute certainty that human capital is the single only asset that truly guarantees permanent, unshakable long-term financial sovereignty.